Welcome to Inside India. I'm Amitod Singh, and these are your headlines. Microsoft making a big bet on India, splashing out over 17 billion in AI investments, its biggest capital outlay in Asia. And Indigo apologizes for the travel chaos, saying its operations are now fully stabilized as Indian authorities ordered the airline to slash 10% of its planned flights.
Indigo is back on its feet and our operations are stable. We've let you down when a major operational disruption happened, and we're sorry for that.
Meanwhile, there's caution in the markets ahead of the Fed's final meeting of the year, where it's widely expected to cut rates. There's a lot happening. Let's go straight to JP Young for a quick check on the Asian markets. JP, how's it looking?
Yeah, happy hump day, Amitabh, but not so happy with how the markets across Asia Pacific are flashing this hump day. And again, looking a bit tight and tepid right now, with markets just staying cautious hours before the Federal Reserve's decision later on. Now, while there are expectations they will cut rates, there are expectations at least or there is a chance that the Fed might be striking a more hawkish tone and becoming more data dependent moving forward, which means less room for possible rate cuts or perhaps higher for longer once again with regards to rates out in the United States. Take a look at the Nikkei 225 now, down by about 0.4%, and we are seeing that mainland Chinese markets also looking quite hamstrung right now, including that of the Hang Seng. Now, one of the things we also have to note with regards to China is that we got inflation data coming out of the world's second largest economy that showed factory gate prices contracting by more than expected. More importantly, this means that they've been in contractionary, deflationary territory when it comes to producer prices since the middle of 2022, indicating that there's still a lot of questions about a possible slowdown in the world's second largest economy. One thing to also watch out for today are how property stocks in mainland China are doing, because today is a bit of a reckoning or a moment of truth for one of their biggest property developers, China Vanke. Their creditor meeting, much anticipated creditor meeting, kicks off today with China Vanke looking for a 12-month extension on the first of a series of bonds that are set to come online or mature until the middle of next year. Now, again, just showing flashes once again of possible liquidity concerns in a sector that seems very important for the Chinese economy, and perhaps also guiding some of the malaise that we've seen playing out in Shanghai and Hong Kong. Take a look at property stocks now, with China Vanke down by about 1/3%. Kaisa Group, though, down by about 1%, and definitely some of the issues you want to watch when you're looking at markets outside of India and across the broader region here in the Asia-Pacific, Amitoj.
All right, thanks so much for that. JP Young giving us a sense of what's going on in China and the rest of Asia. But also, let's give you a kind of a prediction on what's going to happen today in the Indian markets. They're coming online in about 45 minutes. At this point in time, it's looking rather muted. It has been a time where over the last 2 days, a lot of selling has taken place across sectors, and it's frankly a bit dumbfounding. Most analysts haven't been able to understand what's happening, but clearly they're tracking what's going on in the US and in Asia, these mixed cues that we're getting. But there is a cautious tone, and that cautious tone is playing out in India more than perhaps in several parts of the world. You're seeing a lot of selling. There is a focus on the Fed rate outcome. There is a focus on the rupee. Take a look at where it is right now. It's fallen. It's actually strengthened, above 89.95, 96 right now. It was around the 90 region. It had broken through that psychological barrier. There was uncertainty around whether the RBI would intervene. And remember, the Indian government, the finance minister, and of course the RBI indicating that they're not too worried about the rupee, but our macro economists worried about the rupee. That's the big question. We'll come back to this in just a bit. A quick check on US Treasuries. Also, all eyes on the Fed today. As we said earlier, we count down to the Fed's December policy decision. Markets are largely pricing in that 25 basis point cut. CNBC's Steve Leisman has more on CNBC's latest Fed survey.
Respondents to the CNBC Fed survey expecting a hawkish cut at this meeting. That is, a cut followed by a pause, but also showing deep divisions over whether the Federal Reserve should cut at all. And that likely reflects a split on the committee itself. 87% say the Fed will cut this week by a quarter point, but just 45% think the Fed should be cutting. 2 dissents are expected, and only 35% believe there'll be a follow-on cut in January. Scott Wren of Wells Fargo Investment Institute writes in with the survey, the Fed will cut in December, even though you can make a very rational argument that they should not do anything. Continued high inflation is now seen as the #1 risk to the economy. It was in the #4 slot in October. The AI bubble bursting, a new entrant there, is in the #2 spot, followed by concern about Federal Reserve independence and the fiscal deficit, along with administration policy uncertainty. Meanwhile, the growth outlook has been ticking up, running at 2% this year and higher next year, while inflation forecast to remain well above the 2% target for the next couple of years. Diane Swank, chief economist at KPMG, says most are underappreciating the likely stimulus due to record tax refunds in the first half of 2026. That means we're also likely understating the risk that inflation could stick. And not much downside is really seen in the job market, the cause of a lot of concern out there, with the unemployment rate seen rising only a few tenths next year and declining actually in 2027. Still, several respondents believe the Fed needs to cut because of a weakness in the job market. Among them, Alan Sinai of Decision Economics. He writes in, the Federal Reserve is behind the curve again, this time on the widespread weakening of the labor market. A preemptive 50 basis point cut in the federal funds rate is the right thing to do. And that is what likely motivates the Fed to cut at this meeting, the greater risk that when the data finally do come out, it will show a weaker labor market, more than the risk that it will show higher inflation. Steve Leisman, CNBC Business News.
Meanwhile, President Trump is set to start a final round of interviews to select the next chair of the Federal Reserve. Potential successors to Jerome Powell include Kevin Hassett, the White House economic advisor, who's considered the frontrunner in the race, as well as Fed officials Michelle Baumann and Christopher Waller. Trump has been urging the Fed to lower rates quickly. The president spoke at a rally in Pennsylvania earlier this morning and suggested he could stack the deck even more in his favor by replacing some Biden-appointed Fed officials. Take a listen.
We have a lousy Fed chair. And by the way, it looks, you're going to have to check this, please. I just heard it could be that all 4 commissioners in the Fed signed by Biden, including Too Late. You know who Too Late is? Too Late, pal? Jerome Too Late. He's too late with his interest rates. But I hear that the auto pen may have signed those commissions. If they signed those commissions, now maybe I'm wrong, but we're going to check. I don't know. I think it's something we have to look into.
And big tech isn't just wooing President Trump. There's a lot happening. Microsoft is rolling out $23 billion in new AI investments with a massive $17.5 billion earmarked for India, its biggest commitment in Asia. CEO Satya Nadella meeting with the Indian Prime Minister Narendra Modi as he kicked off a 3-day visit to the country and saying that the 4-year plan beginning 2026 will give Microsoft the largest cloud footprint in India, including a new hyperscale data center in Hyderabad. Nadella saying it would go towards building India's sovereign AI. Microsoft is holding 3 days of AI conferences starting today in New Delhi, Bengaluru, and Mumbai. And on the trade front, there's a lot that's going on as we are speaking. New Delhi is holding trade talks with the European Union. Those will continue, they say, amid efforts to fast-track negotiations heading into a year-end deadline. Both sides just wrapped up another round of trade talks just this week, and sources say several issues still remain, including tariffs, market access, and sustainability commitments. Those have been discussed ad nauseum for several months now. India is reportedly looking to deepen defense ties with Russia. Remember, Vladimir Putin was in India, the Russian president. Now, sources telling Reuters that executives from Indian arms makers, including Adani Defense and Bharat Forge, attended meetings in Russia to discuss joint ventures in the sector. Both sides are reportedly considering collaboration on air defense and weapon systems, including fighter jets, and are also mulling Russian arms production in India. The meetings are said to have taken place back in October, but had previously not been reported. India's military ties with Russia have been a point of concern for European diplomats, especially as about a third of India's arms come from Moscow. Now, the Asian Development Bank has just released its latest outlook, raising its Asia-Pacific growth outlook in both 2025 and 26 due to strong tech exports and reduced tariff uncertainty in the region. The bank singled out India as an outperformer, projecting growth of 7.2% this year and 6.5% next year due to robust domestic consumption and steady expansion in the manufacturing and services sector. ADB's chief economist, Albert Park, was on Squawk Box Asia earlier this morning and elaborated on the strength he's seeing in the Indian economy.
We're very bullish on India. This year, we've upgraded growth from 6.5% to 7.2% because we're seeing very strong consumption growth supported by tax cuts and tax standardization, which should continue to yield benefits with more efficient kind of resource allocation and greater demand going forward. We also had a really good monsoon season, so high agricultural productivity, high rural income growth, and this has also supported high consumption growth in India. If we can keep that going into next year, I think that would be beneficial. India just announced also a major set of reforms to reduce labor regulations, consolidate them, to make the allocation of workers more efficient and more flexible, to also support more dynamic sectors and to promote greater investment. So although public investment has come down a bit this year, we're expecting as growth continues and capacity utilization continues to increase that we could see the private sector step in and support investment going forward into 2026.
GDP growth.
All right. Well, to talk about that and much more, we have Trinh Nguyen, senior economist at Natixis, right here with us in the studio. Thanks so much for coming. We usually have you on Zoom. You're here now, and that's great. You heard what was said by ADB, saying that they do see the private sector stepping in and supporting investment going into 2026 in India. Do you see that happening?
Well, I think the big question for India is really income growth and where that will come from, because we have the low-hanging fruits this year, which is the GST rationalization, higher loan growth for households, and so on and so forth. Going to next year, we're going to need to have job growth and wage growth. And one of the positive is really this finally implementation of the labor code, which passed in 2020, but finally implemented. So I do think that there is some space, but there is also some weakness. One of the weaknesses we saw was, if you look at the credit growth data, even though it recovered, it's really the micro and the smaller enterprises. The big industries saw a big deceleration of credit growth, and that's a big concern for private capex moving forward. The big picture for India is really private capex has been broadening, but the slowing down of credit growth is a concern. So we look into 2026 with a deceleration from that angle, meaning we do see some deceleration of investment.
You don't agree with ADB then? Yeah.
I agree that India will have the strongest, amongst the two strongest growth in Asia.
Okay. Do you have a number that you've put out?
Yes. Well, our number is a little bit slow. It's in 6.2% for 2026, and we use calendar year for that. And I do think that that weakness is really coming from the deceleration of really high growth this year, which is driven by consumption. So we're going to go into 2026 with capex decelerating.
Okay, 6.2% compared to ADB's 7.2%, and so many others have their different numbers. Does this factor in the low deflator, the changing base rate in 2026 Feb, the base year, I beg your pardon?
What is really important for India, and also depends on what kind of investors you're talking to, nominal GDP growth is very key. Yeah. Even though Q3 GDP growth accelerated, for earnings, nominal GDP growth is very important. For sectors, whether or not that sector is growing will be very important as well. As you know, the economy is not the stock market. The economy is made up of a lot of smaller companies, whereas the stock market is more very, very much large caps. So as a result, this is one of the reasons why there's a big divergence between Indian equities performance vis-a-vis the rest of Asia, which is catching up to India this year, given the fact that we have front loading of rate cuts across Asia. India also cut rates, but it's cutting rates not because growth is strong, but it's cutting because nominal GDP growth is weak.
Okay, that's interesting. And you see them continuing to cut rates?
Absolutely, but I think there will be a little bit of a pause. I think for markets, what's also going to be important is also the policy regarding the rupee, right? It's been a huge shock absorber of this 50% tariff rate.
And they're fine with that. They've suggested they're not worried about the rupee. They're worried about volatility. The finance minister has also said that. They're okay with it being the shock absorber. They believe, and analysts are suggesting, that this is a strategy that they've chosen.
Absolutely, because its trade deals are going very slow. As you know, India was always imminently getting a trade deal. But India is changing in its own pace. It's changing its own ways. Opening up India in the way that the US or the EU would like will take some time. And I think those trade deals talks will continue to intensify, will make progress. But in the meanwhile, we have two challenges with India. One is not only do we have the 50% tariff creating issues for labor intensive, but the second is really the erosion erosion of competitiveness, right? The competitiveness vis-a-vis China, where they have today deflation again, and meanwhile, even though Indian inflation is decelerating, so on a relative basis, it's not competitive. So I think for the RBI, it looks at the external sectors. So domestically, people are happy with the high GDP growth, but when you look at external sectors, it needs a little bit of a boost up by the central bank.
Okay, I have so many questions for you, but I want to go back to something you said around tariffs to CNBC on this show a couple of months ago. A lot of these roadblocks to India's domestic development, you said, can be pushed through by outside forces. An example, India will find it very difficult to lower duties without using the US as an excuse to expose India to much more competition. By lowering tariffs, it can raise subsidies. That's what you had indicated. In other words, the government has an opportunity to have this pressure from the US tariffs, use that and bring in reforms that they couldn't have done otherwise because of whatever political reasons or economic reasons. Do you stick with that?
Absolutely. One of the ways to unite a country that is rather opinionated in different directions, different democracy. One of the positive of democracy is that it moves, but it moves in a slow ways because you need to reach a consensus, is the fact that reforms have been very difficult.
You're saying that's what's happening?
Right. And one of the facts, the reason why we have the implementation of the labor code finally is really this external pressure. The rationalization of GST is that pressure. The fact is, of course, we need GST as a revenue source, but at the same time, given the fact that external sectors are so stressed, you have to push inward for sources of growth.
Is that why we're not hearing the end of negotiations on the trade deal? That they just keep protracting. 6 months ago, they're about to happen. 4 months ago, about to happen.
I do think trade deals will come. I think I get a lot of pushback around this, but I do think India does need it. There are ways for it to get there. It does not give up its red line. If you look at the trade deals with Korea, for example, Korea has managed to keep rice and beef, which is what they care about. They do not want to open market access to the US. Japan is the same. So in other words, India does have this vote bank issue that they cannot push back on, and rightly so. But at the same time, the agriculture sector is also primed for a boost of productivity. The yield, and also given the fact they have 40% employment, but at the same time, only 60% in terms of value add to GDP is a challenge. And I think that's something that within India, there is a consensus to reform that. How to do so is a challenge. So I do think the opportunity for reforms for India is very ripe. Opening up India gradually and rapidly is the way to go forward.
But the agricultural red line will remain, according to you. That is not something that Prime Minister Modi's government will, take this opportunity on, the US tariff pressure.
Absolutely, but it can take the opportunities on other sectors. The auto sector, I think, is one where there is low-hanging fruit to be pushed.
Okay, very quickly, inflation numbers coming in this Friday. Do you have a take on that?
I think India inflation obviously is skewed by weak agriculture prices, and that's a regional phenomenon. I do think that looking to 2026, we have to be mindful of the fact that the CPI basket is too overweight by food, and so we have some upside risks to inflation going to 2026 if we have, for example, one of the two key drivers is really oil prices and food driving it. The second thing is the basket is primed to be changed. It's rather
2026 Feb, it's going to change the whole
thing. So I do think that there is a room for inflation to go upward in 2026. So the room for the RBI to cut, I think there is one more rate cut to go, and it's probably going to pause, but it would try to do so in the first quarter, if not beginning of the second quarter, to make sure that will push through to help with nominal GDP growth.
Okay, let's just bring up a couple of things. Microsoft Satya Nadella meeting the Prime Minister, Intel CEO meeting the Prime Minister, Intel having a deal with Tata Electronics, MOU, 17 billion coming in to the AI industry from Microsoft. That's the pledge over about 3-4 years. I don't know what your position is on the AI trade of India, because the question here is, for the global investor, is India the hedge against the AI bubble or the early AI trade?
So I think there are two ways, right? India is a big domestic demand. So in a world where the world, as you know, regional trade and global growth has been driven by tech sectors. In Asia, we manufacture much of it. Exposure is Taiwan, Korea, Vietnam, Malaysia, and so on and so forth. India is really down on the exposure. And that, I think, is a positive. And India, of course, in terms of exporting that is very low, but India as a market is very big. And that's why Microsoft is positioning itself. This is a play for India. Right? So I do think, yes, it is both. It is that there is room for India to grow in terms of providing for India. The second one is obviously India to be a hedge in that it is not exposed
But you
in
can
the
only
region.
choose one, can't you? How can you have it as a hedge also and then put your money into the AI trade because AI is going to become big in India?
I think you should think of relative terms, right? Because India is a big, for example, if you look at India autos as a sector, huge domestically, but it's not trading it, right? In terms of its imports of autos, very low. So when you think about shocks to Trump tariffs in terms of 25% tariff, you think Japan and Korea, not India, right?
Okay.
So I think that's the way you should look at it. It is a big sector, but because it is really to serve the Indian market, this is why it will not be as exposed in terms of blow up if there's a cyclical slowdown of the tech sector in the second half.
Can India catch up, or will it continue to lose jobs to AI as it has been? The entire tech sector is losing jobs. There have been layoffs. Is it too late?
I think that's a big debate. So there are two Indias. One is that it's losing competitive in merchandise trade, but the service sector is doing amazing. The service sector can gain from this AI servicing of whatever, but at the same time, it's also losing anything that can be automatized by AI. So I think net it could be very neutral. That's a big debate. But what is key is that you cannot rely on one or two sectors for a country as big as India with 1.4 billion people. And reality is that tech, AI and so on and so forth has been an outperformer for India in terms of income growth, for driving urban growth. But meanwhile, we still have so many people still left behind. And I think this is why the trade deal is important in that it's broadening out this income base. And we go back to the first question, which is that Indian growth is driven by Indian consumption. But to drive sustainably that growth is we need to grow the middle income. And for that, you need income growth.
Okay. What happens if we don't have a trade deal with the US?
What we will have is really India not really an important export market. Already you see that it's the worst performing emerging markets in terms of in Asia in terms of export growth into this year. Actually, it did pretty well in exporting to the US, but it's losing other markets. And it's also at the same time also losing industrial base in sectors that we mentioned, which is labor intensive. So I do think the risk for India is not just exporting its way out to gain nominal growth, but to be giving up on those sectors altogether. Right? And by doing that, then it's giving ways for countries like not just China, but also Vietnam to export into India. And I think fundamentally that has a very long-term consequence for India to stay competitive.
It's not giving away. It's the US that's forcing it to give away because India can't, has that red line around agriculture. Okay, the final question. We're completely out of time. I want to just get your take on the Fed cutting a rate, most likely, as what everyone's predicted, and what that does to the India rupee, the India economy, very quickly.
Short term, India rupee stays weak, but I think longer term, if you look at the second half of 2026, there's a lot of room for the rupee to strengthen on the portfolio side. For example, if you look at real rates in India, it's the highest, right? It's really concerns about trade deals and so on and so forth that's really driving the rupee downward because of this trade deterioration. So I do think the Fed cutting rates is going to be wonderful for India in that it again raises its competitiveness in terms of real rates, and there's going to be a push for investors to look for real yield, and India has it. It's actually, in fact, the outlier in terms of real yield. Even if inflation were to rise, we still would have very high real yield in India. And growth, the domestic play remains the key. As I said, investors will start looking into India as the external outlook gets darker in the second half of 2026.
Okay, they're too slow, these investors. But anyway, thanks so much for that. That was Trinh Nguyen from Natixis. This was a bit of T20 cricket that we were playing. Inside India, we'll be right back. Don't go anywhere. Welcome back. You're watching Inside India. Some of the stories that we're keeping tabs on outside of India. Let's take a quick look at those. Indonesia's trade deal with the US is now at risk of collapsing, with Washington accusing Jakarta of backtracking on key commitments agreed upon in July. A US official says Indonesia is reneging on promises to scrap tariffs and remove non-tariff barriers on American goods, which are concessions Trump had touted as a huge win for US industries. Ukrainian President Volodymyr Zelensky met Pope Leo at the papal residence yesterday. This amid efforts by Zelensky and European allies to counter a US-backed peace proposal widely viewed as favorable to Russia. Ukraine and its European partners are expected to present an updated version of the peace plan to the US soon. Australia has become the first country in the world to ban social media for children under 16, blocking access to 10 of the biggest platforms, including TikTok, Facebook, YouTube, and Instagram. The regulation kicked in at midnight on Wednesday, local time, and companies that fail to adhere to face fines of up to $33 million. Several countries, including Denmark and Malaysia, have shown interest in studying or emulating Australia's model. Inside India is taking a very quick break. We'll be back in just about 2 minutes. We're counting down to the market open in India. This is how we are shaping up. It's been mixed in Asia, and it's looking like it's going to be muted in India. Remember, India has had 2 days of, well, mostly selling, given what's been a cautious tone from the traders out there. Keeping in mind that we have no new information, really material information, when it comes to the US-India trade deal. And also, there is the Fed rate cut that is coming later today, US time, tomorrow morning, for Singapore and India. We're going to be watching all of that very closely. All eyes really on the rupee. There you go. It has once again gone up over 90, so weakening against the US dollar. That's the biggest concern, although officially that's not what has been stated by the government or the central bank, indicating that they're just watching out for volatility. We're watching the rupee for much more than that. We'll be back to track the Indian markets in just a bit, but let's give you a sense of what else is really the biggest story in India at this point in time, the update on the situation with Indigo. The CEO making comments yesterday. CNBC's transport and travel reporter Monica Petrelli is right here with us and has been tracking this entire a mystery. I want to call it that. What's the latest?
That's right. We did hear from Indigo CEO yesterday, but he's not the only one with something to say here. We saw Indian regulators taking swift action against the company, saying that Indigo would need to reduce its flight schedule by some 10% in the winter domestic schedule. That's going to be around 200 flights per day. And regulators are asking Indigo to focus on areas where its rivals are flying, presumably to prevent any further disruption to travelers in India. But we do see this also coming upon a busy travel period as drier weather is ushered in. This, though, coming after the government summoned the CEO into a meeting which it released photos of onto X showing what seems to be a very tense exchange is happening. We did see right there some of those photos we're looking at there. We did see, though, CEO Peter Elbers issuing a taped address, again apologizing for the situation here, but saying that the company on better footing, in fact, earlier than it expected. Have a listen.
Indigo is back on its feet and our operations are stable. We've let you down when a major operational disruption happened, and we're sorry for that. On December 5th, we could only fly 700 flights. Thereafter, gradually yet steadily improving to 1,500 on 6th, 1,650 on 7th, 1,800 yesterday, and today more than 1,800. As of yesterday, we are back of flying to all our 138 destinations in our network, and our on-time performance has also been normalized. Earlier, we had indicated to normalize between the 10th and the 15th of December. I can confirm now that today, as of December 9th, our operations are fully stabilized. We continue to work in full cooperation with the government. And now that the immediate crisis is dealt with, we started to focus internally on what has led to this, lessons learned to be drawn, and how to emerge stronger from this.
It's really that question, what led to this? Many demanding an answer to in a situation that's really amounting to be the latest and perhaps greatest showing that the government is willing and willing to put their money where their mouth is in terms of demanding stronger policy adherence in the aviation sector. This even if it means a public showdown with its largest carrier. And I would say, even despite the fact that there was an exemption granted for the very rules that started these mass cancellations in the first place.
Yeah, public pressure is one thing. Thanks so much for that, Monica Petrelli, giving us the latest on Indigo. But we're going to continue the conversation with Harsh Vardhan. He is the chairman at Star Air Consulting. But perhaps for context, the former CEO of Vayudoot Aviation, a now defunct India regional carrier that was merged with Indian Airlines in the 1990s. So, sir, you know this aviation sector quite well in India particularly. I want to start by just understanding what Monica was saying and playing off that. 60% domestic market share, the biggest player in India. Has Indigo inadvertently or otherwise made the point to the government that it is indeed too big to fail?
No, I think Indigo seems to have been caught unaware with their own follies. I don't think the government, they had any intention to slow down. Perhaps they weren't even aware of what is happening within their own organization. And system just collapsed. The government policy of FDTL, flight duty time limitation, which was revised a month ago, and then it has been going on for a year as a policy change. They may have taken it very lightly, its consequences. But what has happened does not actually explain a mere impact of the new FDTL policy. So,
okay, so then if you're saying that's not the case, and why was a one-time exemption given to Indigo if they're not too big to fail?
You see, because basically, look, exemptions of this nature in a major policy change is not an exception this time. Even earlier, when there are major modifications and other things, sometimes the operators find it difficult to cope up in a very short time due to spares or manpower shortages. So sometimes these kind of extensions are given. And let us also understand that with the existing policy, with the old policy, the system has been running for all these years. So 3 months extension, because Indigo made a case, they wanted to put the whole blame on the of their fiasco onto this policy, and perhaps that is what they wanted to tell the government, that because of you we failed. So this is where I think government said, all right, you take 3 months time more. But even after that, if you see really, they took very long time in trying to get there. And although the CEO is saying that the operations are normal, they're still short of 400 more flights, which they were operating earlier. So it is far from normal. And if you go to the ground level, the operations will take at least one more week before they will show some kind of semblance of an order.
Okay, so we understand that sometimes the government or regulators have to give these kind of, extensions of 3 months. We're looking at the stock right now, and it's down about 11%. There is going to be a financial implication for this entire crisis. Sure, this is done sometimes in a democracy where public pressure, plays a big part in decision making. But I am a bit foxed about one thing. What strict action is the government truly in a position to take that it says it's going to actually go ahead with? And can it really be significant? Could it cripple Indigo as an airline?
No, let's understand that Indigo so far has been a star performer, and the major growth story which Indian aviation has been talking about, Indigo has shouldered the major burden of it. But let's understand that in the current actions which government has taken against an operator are perhaps the first time that they have asked them to reduce their flights by 10%. They've also put a freeze on the fare levels so that people are not exploited. And you can go up to a point, not beyond a point, so that there is a fair compensation for delayed flights and other things. So the other thing the government can do is perhaps stop their further expansion till they are able to prove that they have sufficient manpower and resources to expand. But given the current scenario where the traffic is growing at unprecedented rate, Indian aviation is growing at 10 to 11%, which is highest in the world. And the growth story cannot be avoided. So basically, the government can only wait for Indigo to put its house in order. Meanwhile, it can encourage other operators to streamline and improve their working and increase their fleet. But that's, it's not a very quick solution. It will take time to augment the fleet and other things. And even given the Indian environment, the investment environment for India in aviation industry, expecting that too many operators or too many new players will jump in is also a kind of wishful thinking.
Okay, very interesting. Something doesn't make sense then, because you have the aviation minister in Parliament making very strong comments that we will take the strongest, the harshest action on Indigo. There will be complete accountability effectively. That was the sentiment of what he said. And you're saying that there's not so much that they can actually do. So what is the smartest way of accountability, right?
Yeah,
sure,
go ahead.
No, go ahead.
No, the only thing they can do is perhaps, do a few head rolling at the highest level in Indigo. But I don't think there is much the government can do, honestly.
So does the CEO go, is what you're indicating?
I mean, that can be one of the kind of symbolic action the government can take. But given the scenario, you cannot stop the growth of the industry. You cannot close down the airline, the only airline which is profitable in India, despite all this. So you can't, you can only do some kind of arm twisting, not beyond that.
Who has done the arm twisting so far? Indigo or the government?
I think now the government has an upper hand. It may have been the initial thing.
But before this crisis, This entire crisis, who was doing the arm twisting?
I think Indigo did feel overconfident about their own position in Indian aviation. And then it is the people's experience, people's revolt against it is what led the government to take strict action.
Okay. I want to ask you this because at the end of the day, this entire crisis is about pilot fatigue, right? Safety. Focuses on night flying exemptions for pilot hours. We can get into the weeds about how the night is defined now from midnight all the way to 6 in the morning as opposed to the earlier 5 in the morning because of the exemption, and gone back to 6 night landings, all of those things. But at the end of the day, who will be responsible because of this exemption in the next 3-4 months if there is an incident because of pilot fatigue? Has safety been compromised for convenience?
I think, now because the scrutiny is very intense, the partial rollout of the policy would start. It is only in case of very emergent situation, the guidelines would be avoided. And secondly, you have to understand that the 10%, how did the 10% reduction came about? It is essentially because the Indigo indicated that they have a 10% shortage of pilots to roll out the full policy of FDTL. So because of that, the government has now curtailed their flights by 10%. So it is a sufficient manpower with Indigo to operate the fleet, operate the flights which are now permitted to them. So I think indirectly it is within parameters. So this policy, while they may have got the exemption for 3 months, it doesn't mean that they have to wait for 3 months to implement the policy. According to now with the new regulations, I think there is sufficient manpower for them to implement the policy right away.
Yeah, but we still don't know what will happen if there is an incident during that transition. Anyway, sir, thanks so much for joining us. Harshvardhan, sir, the chairman at Star Air Consulting. Appreciate all your perspective. All right, we're counting down to the market open in Mumbai. We're about 2 minutes away, just 2 minutes. And we'll also be back in just those 2 minutes. Welcome back. We're watching the Indian markets as they come online. The Nifty 50, well, it's been a muted start. It's been mixed throughout Asia after its tracked cautious U.S. market, keeping in mind what is expected. The big development, the Fed likely to cut rates. That is what is likely to happen Wednesday in the U.S. We're watching that. The Indian markets also watching that, more or less, just staying in that region of 25,800. That's what GIFT Nifty had indicated, but slightly lower than that, actually. 89.96 is where the rupee is at. It's not gone up to the 90 psychological area, but it's been hovering around that. And RBI intervention will be something we'll be watching out for, especially after the Fed, as is expected, cuts rates. That's what is going to be key. All right, we'll come back to what's the latest with the Indian markets. Remember, we are watching what's going on with Indigo, tracking that fallout. The stock has fallen 10% in the last week. At this point in time, just down about 1%. It did open slightly in the positive. It's gone back down very quickly. Those are shares of its owner, Interglobe. A lot developing with the entire situation of Indigo. Remember, cumulatively, 4.5 billion was cut from the company's market value in the last couple of days. 7th day of selling straight. The stock dropping 8.7% on Monday, also dropping yesterday on Tuesday, and right now continuing to drop further, going from a bit of a jump and now 1.18%. Now let's keep tracking what's happening in the Indian markets. BlackRock is deepening its push into India's clean energy markets. Its Global Infrastructure Partners Fund will invest 20 billion rupees, or about $223 million, for a minority stake in Aditya Birla Renewables, with an option to raise that to 30 billion rupees. The deal values the green power company at 146 billion rupees, including debt. Aditya Birla Renewables is a unit of Grasim Industries, part of the Aditya Birla Group. All right, now Asian private credit investment firm Certis Credit raising $520 million at first close for its fourth fund focused on India, one of the largest for an Indian private credit fund. The fund, which focuses on high growth companies across a range of sectors in India and Southeast Asia, still aims to raise $1 billion by the end of 2026. Joining us now to discuss that and more is Kanchan Jain. She's the head of Certis Credit Group. Kanchan, thanks so much for being in the studio with us. We appreciate that. I want to start by getting a sense from you about everything that's been happening in the latest developments. But Ray Dalio was on our show, Squawk Box and Middle East, and he said that the cracks are starting to form in the market in private equity. UBS chairman Com Keller also warned against growing risk in private credit as the market continues to boom. He said there is clearly an asset bubble going on in private credit. Your response?
I think, some of these comments we need to recognize in the context of the US private credit market, which I think, the largest market, and in fact has grown really phenomenally in the last 2 or 3 years. So at some level, the concerns come from there. I think the story is very different when it comes to Asia private credit market. And I think a couple of things here are important to note. One, that in Asia, private credit gets used very differently. Actually, most of the capital here goes in to fund real productive growth. It's not necessarily just leverage to sponsors, so that itself, is a very big difference. I think second, in Asia, the market's still very underpenetrated. Mm-hmm. Most of the concerns in the US private credit market at some stage have really come from how fast it's grown, how overexposed some of the investors are, the number of deals that get done, the number of managers that are chasing deals, which all result in sort of saying, is there dilution of covenants? Yeah. Right? Is there enough underwriting happening? Things like that. Whereas in Asia, I think it's a big opportunity because one is underpenetrated. There are a handful of firms doing that for all of Asia. Two, it is going in for real growth. Three, I think, we are a tenth of the size of the market in the US, right? So you don't have, those kinds of concerns here. So you do need to look at where it's...
Okay, so I see that you've called out what is perhaps a false equivalence, and I appreciate that. The only question here is that when you and your firm have raised $520 million, and I believe, and correct me if I'm wrong, most of it is from outside.
So about 70%.
70% of the money is coming from global investors, right? Not Indians. And that money is going to go into India. And there is this talk of a bubble. And if that bubble is pricked, right, as has been said by Jeffrey Gondlich, founder of Double Line Capital, he's saying that private credit could trigger the next financial crisis, describing certain lending as garbage lending. it is going to have a ripple effect into India. Would you not agree?
See, private credit and private markets is long-term patient capital, right? You don't have, when we raise money into a closed-end fund, right, it's not as if people can just pull out that money, and I think that's the opportunity for Asia and India, so that's number one. I think when people are talking about bubble, they're talking of either a systemic risk, which means, there's going to be just range of defaults and unstoppable defaults and losses that potentially some investors may suffer. Again, we're at a very different, stage on that in India. Yes, if there is a big issue with US private credit markets, will it be harder for Asia to raise money because there are questions on private credit? Possibly. But I think it can also be a positive, right? Once people, and I think at some level, the big change that has happened in Asia is we've moved from being a special sits market largely to a performing credit market. So there is a very real work being done on what's the underlying risk profile. Is this return going to make sense, for me as an investor, which itself is a big thing, which means somebody's going to come in and say, okay, let me look at what's happening in Asia.
Okay.
Do I have the same issues? It's an opportunity. It could actually turn into
Fair enough.
more
Okay,
flows
now,
for Asia.
I think there's more context that we need as to why you're just a veteran on this and a thought leader in private credit. You're a former MD at HSBC. You've consulted for Kotak Mahindra Bank. You've led Religare as CEO and then founded and led the private credit platform, Assert, is that we're talking about right now. In that context, what is, in the simplest terms, the state of private credit in India?
I was the CRO at Religare.
Oh, my bad. Apologies.
No, that's fine. See, I think, fundamentally what private credit is doing is addressing a very, very structural need in the market in Asia, right? The technology, let's say, got founded in the US in the sense that you have an entire source of capital away from bank lending that is now available for debt needs of various corporates, right? Let's say that's the technology, right? It's not public. It's a different source of capital than depositor funds, right? And these are nuances which really, provide kind of a different investment profile and risk return profile that private credit can address, right? I think in Asia, you're looking at underlying economies that are high growth, need for capital, not just in the form of equity, but in the form of debt. A real shortage in the capital in a high growth economy like India, right? We're not an over leveraged economy at all. And for any large economy, you need multiple forms of debt capital.
Sure.
You need bank lending to do a certain kind of lending. You need debt capital markets. We don't have a leveraged loan market. We don't have a huge investment grade high yield bond market. So there is significant end users that cannot be addressed by bank lending.
Not fair.
Which can be addressed.
But,
that's the reason private credit exists, right? It's become mainstream.
I guess the concern has been around diligence and risk appetite, right? What is the methodology that makes this possible in India? Because historically speaking, if you're an Indian, going to a private lender is like, no, I don't want to do that. I'd rather go to the bank. Even if they have those strict norms, they have so many of those bureaucratic things that make that difficult. How is that something you have confidence in? Is something that is hard to explain, right?
So, you know what? Things have very significantly moved in the last 10, 15 years. And I think everybody talks about the new IBC code, right, in India. And yes, that's been a game changer in a lot of ways. A lot has changed, a lot needs to change, right? But you know what you're dealing with, so you can structure around it. Another interesting lesser-known fact is presence of credit bureaus and information sharing in India has very significantly improved. That allows for a private credit lender or a manager like us to do the kind of diligence we would want to do, right, to lend money to a lender. So I think on the investing side, things have improved. Opportunities have expanded, right? And the reforms and the regulatory, landscape for these funds have improved. So that allows us to make these investments. Interestingly, on the borrower side, I mean, I started in India 30 years ago, right? And then I worked in London in Asia, but again, back focused on India. I think what has significantly changed is the number of existing mid and large companies that have 20, 30 years of vintage behind them are recognize the tremendous wealth creation opportunity they have ahead of them, right? And they are looking to fund their businesses in a more stable and in a more diversified manner. They are looking for newer sources of capital, right? So even within the private credit setup, if you are a manager with a pedigree, you've been around 10, 15 years, you've provided patient capital for growth. I think those are big things. And, borrowers also take note of that and are, willing to diversify.
You've also said earlier that the first close, yours, showed that Asia, particularly India, is taking a larger share of global private credit portfolios. But there's something else also happening. Motilal Oswal is the latest addition to India's crowded private credit market, putting in as 30 billion rupees, IPO in 2 years perhaps. There's a lot of internal competition. Where do you see yourself in that?
See, I think the fact that there are newer funds coming up, again, just adds to the fact that it's a very large opportunity in India. I always feel it's not a market if there are 3 fund managers, right? Sure. It is a market if there are more. And in some ways, there is no shortcut in this market. You need to raise multiple funds. You need to deliver the exits, right? And I think that sort of gives you the fundraise. Mm-hmm. We started 11 years ago when I think nobody was doing performing credit and mid-market credit in India. I think new funds is good to have. It establishes the asset class. Every fund manager has their journey. All right. We're completely out of time. I'd love to have asked you about 2047, the intent of India to be developed and what role private credit plays in that. But unfortunately, that's all the time we have. Kanchan Jain, thanks so much for joining us. Thank you for having me. Yeah, appreciate that. Okay. That's all the time we have today on Inside India. Keep watching CNBC. Access Middle East is up next.